Good day. My name is Rossouw and I'm a portfolio manager with Adviceworx Private Client Securities. I'd like to spend the next quarter of an hour talking to you about the global COVID-19 pandemic and the impact that it's having on investment markets. I'd also like to share some thoughts with you on how Adviceworx sees the way forward. One of the paradoxes in the administering of COVID-19 vaccines is that while many countries in the developing world are desperately trying to obtain vaccines for their anxious populations, some rich countries which have ample supplies are battling to get people to come forward and be vaccinated. This is particularly true of the United States, home of countless conspiracy theories and urban legends. In an effort to achieve population immunity, some states have even resorted to launching lucrative lotteries, which are only open to people who have already been vaccinated. By Friday night, nearly 167 million people have been infected with COVID-19 worldwide, and more than 3.5 million people have succumbed to the disease. The United States remains hardest hit, with over 34 million infections and more than 603,000 deaths. India, Brazil, France, and Turkey still make up the rest of the top 5, and South Africa is still in 20th position in terms of the most recorded cases. The past week saw a general reduction in the number of new COVID cases reported daily, largely thanks to a sharp decline in India. Total infections for the week fell by 13%, from 4.8 million to 4.2 million. In India, new cases fell from more than 400,000 per day to less than 250,000. Brazil and Argentina both experienced rising numbers of new infections, while Japan, which is to host the Olympic Games in July, is still desperately battling its latest outbreak. The daily COVID death toll remains stubbornly high, and the total number of deaths for the past week was 84,700, only 2% less than the previous week's 86,900. India and Argentina saw rises in fatalities of 4% and 7% respectively. In Russia and Nepal, the week's total rose by 6% each, while Malaysia, the Philippines, and Indonesia suffered increases of more than 10%, admittedly off relatively low bases. New case numbers are also rising in these populous nations, and unless vaccination programs are accelerated, East Asia could become the next epicenter of the. By Friday night, just under 1.6 billion doses of vaccine had been administered worldwide, with China leading the way with 467 million doses, followed by the United States with 280 million, India with 188 million, and Britain with 59 million. It is estimated that 750 million people, or 9.6% of the world's population, have now received at least one dose of vaccine, and that 382 million people, or 4.9% of the world's population, are now fully vaccinated. Of the countries which supply this latter data, the United States is in first position with 128 million, followed by India with 41 million, Britain with 22 million, and Brazil with 18 million. While the number for China cannot be confirmed, it is estimated at around 200 million. The death and destruction in Israel and Gaza has thankfully stopped for now, and American factory managers are feeling upbeat. Unemployment in the United States has come down, but many of the unemployed are battling to find jobs for which they are qualified. Across the Atlantic, factories are humming, consumers are spending, and inflation is rising. The United States and Iran are trying to reach a modus vivendi, and the European Union is keen to allow vaccinated citizens to start traveling again, but T's and C's apply. According to surveys conducted by the University of Michigan, Americans believe that higher inflation is here to stay. The consensus seems to be that consumer price inflation will be around 3.1% in a year's time, the blue line, and as high as 4.6% in 5 years' time, the light green line. Regardless of how accurate these views turn out to be, they are a cause for concern because inflation expectations tend to be self-fulfilling prophecies. If people expect goods and services to become more expensive in future, they are more likely to spend now than postpone purchases, which fuels demand-led inflation. America is not the only large economy grappling with inflation. In China, consumer price inflation, the light green line, and core consumer inflation, the orange line, are both heading upwards at the moment. Even more concerning is the fact that producer price inflation, the grey dotted line, is at even more elevated levels than consumer price inflation. This is of concern because PPI is a precursor of what consumer inflation is likely to do in future. Capital markets were volatile this week due to a combination of geopolitical, health, and economic issues. The US bond market seesawed, but gold ended the week stronger. The week's corporate action was dominated by two media macro mergers, and Warren Buffett sold off some of Berkshire Hathaway's energy and banking exposure and bought into insurance, communications, and retail. It was a tough week for cryptocurrencies as China moved to limit speculation in them. Equity markets ranged from flat to slightly stronger, with the Sensex in Mumbai lifted by the apparent retreat of COVID in India. The Sensex was the best performing major index for the past month as well, while the Taiwan weighted index brought up the rear. The CAC 40 in Paris leads the pack for the year to date, with mainland China's A50 in the rear. Over 1 year, the Sensex and FTSE are first and last, and over 3 years, the Nasdaq and FTSE. Despite predictions to the contrary, emerging market equities have not performed particularly well so far this year. In fact, the developed world has dominated, with the Eurozone in the lead, followed by the United States. Britain and Japan have also outperformed emerging markets, whose index is dominated by Chinese stock exchanges. Chinese bourses have been weighed down by the government's crackdown on the technology sector and fears over the potential impact of rising interest rates on the country's exports. Gold is looking more and more like Aesop's tortoise as it moves slowly up the commodity rankings, while the so-called battery metals resemble the hare. Iron ore's fortunes reversed this week, as did those of crude oil and platinum group metals. Coal and cobalt were top and bottom over the past month, while lithium remains the best performer for the year to date, despite running out of steam of late. We remain positive about global equities. Corporate earnings continue to grow in the current low interest rate environment. US price-to-earnings ratios are looking stretched, but equity earnings yields remain more attractive than bond yields. Pan-Europe offers better value, but the most attractive valuations are to be found in Japan and emerging markets, including China. We are, however, keeping an eye on what happens to inflation and interest rates and will react if they take a turn for the worse. For now, we remain underweight global bonds as yields remain unattractive, and if mandated to invest in bonds, we prefer emerging market bonds over those of developed markets. We retain a neutral weighting with regard to global property. Our least favored sectors are retail and office property because e-commerce and work from home could do long-term damage to their profitability. Conversely, these two trends are positive for the industrial and residential property sectors. The hospitality sector should recover in due course, but only once vaccinations have achieved critical mass. On the local front, this week's big news was the start of government's COVID vaccine rollout to senior citizens. As this cartoon illustrates, this is a race against time, as the daily infection and death numbers are steadily climbing and a third wave now seems imminent. Government aims to vaccinate the estimated 5.5 million South Africans over the age of 60 in the next few months, but the program has thus far been beset by administrative and logistical challenges. As of Friday night, well over 1.6 million South Africans have tested positive for COVID-19 and nearly 56,000 people have succumbed to the virus. On Friday, 151 COVID deaths were recorded, nearly half of them in the Free State. Gauteng still has the most recorded cases and the Western Cape the most fatalities at 11,745. Gauteng, the Northern Cape and the Free State currently have the most active cases. Meanwhile, nearly 650,000 people have been vaccinated, 500,000 of them healthcare workers. Inflation rose by more than expected in April, led higher by food and transport costs. Notwithstanding this news, the Reserve Bank left interest rates unchanged on Thursday, but BNP Paribas has warned that a rate hike in the fourth quarter is now likely. Minerals and Energy Minister Gwede Mantashe thinks coal will remain our major energy source since we have so much of it, and load shedding cost us nearly 60 billion rand last year. Minister Ebrahim Patel wants companies to disclose their pay gaps, and the locust plague is ravaging the Karoo and Kalahari. South Africa's gross domestic product grew in the first quarter of 2021, but not as strongly as previously hoped. There was also a considerable divergence in the performance of various parts of the economy. The resources sector, the blue line, was the top performer, thanks to surging commodity prices. Retail sales were positive on a year-on-year basis, but down quarter-on-quarter. The manufacturing sector slumped from quarter to quarter, however, but was positive on a year-on-year basis. Superficially, our resources sector is currently booming. This is not an accurate reflection of the true state of affairs, however. Mining production is actually stagnant, thanks to uncertainty over government's intentions regarding mineral rights. Most of the increase in our commodity export earnings can therefore be ascribed to higher prices rather than an increase in volumes. The main contributors to this state of affairs were platinum group metals, the light blue line, iron ore, the olive green line, coal, the red line, and manganese, the grey line. Friday was Tax Freedom Day in South Africa, the day when we stop working to pay taxes and start working for ourselves. The greater the proportion of the gross domestic product the government consumes, the later in the year Tax Freedom Day occurs. This year's Tax Freedom Day is 6 weeks later than in 1994, which shows how the tax burden is inexorably growing. Relative to the size of its economy, South Africa is one of the most heavily taxed countries on earth. The JSE ended the week more or less unchanged, with financials and industrials up and resources down. Both the bond market and the rand stood their ground this week, and Telkom share price rose sharply thanks to good earnings expectations. Vodacom plans to invest 10 billion rand in its local infrastructure and to also partner with Alibaba in the e-commerce domain. Heineken is courting Distel, and 91, previously known as Investec Asset Management, reported a 27% rise in its assets under management. Last week, foreign investors were net buyers of South African bonds and net sellers of South African equities. The JSE saw a net outflow of 0.77 billion rand, while the bond market enjoyed an inflow of 0.32 billion rand. For the year to date, the JSE has seen an outflow of nearly 15 billion rand, whilst 32.5 billion rand has flowed out of the bond market. The local bond market endured a volatile week, and at one stage the yield on the 10-year SA 2030 bond spiked as high as 9.15%. Thereafter, it made a strong recovery, and the SA 2030 ended the week on a yield of 8.905%. Along with most other emerging market currencies, the rand has seesawed over the past year or two. Last year, thanks to the COVID panic, the rand was trading as weakly as 19 rand to the US dollar, but since then the local currency has staged a remarkable comeback, and it is currently trading at levels last seen in the middle of 2019. We remain slightly underweight South African equities relative to our long-term strategic asset allocation. Domestic equities look cheap relative to offshore equities, both in developed markets and emerging markets, as well as relative to the JSE's own historical average price-to-earnings ratio. Despite the apparent value they offer, local equities remain hamstrung by the weak domestic economy and uncertainty over government's economic policy intentions. Despite the sharp recovery in the prices of some domestic listed property counters, we remain worried over the sector's long-term outlook and heavy debt burden. We therefore avoid property until the outlook changes materially. Domestic bonds remain our preferred local asset class. Yields remain highly attractive, and although we remain concerned over the long-term outlook for South Africa's government finances, we believe that a substantial risk premium is already factored into bond prices and yields. We prefer government inflation-linked bonds at the shorter end of the yield curve and nominal bonds higher up the curve. We are wary of corporate credit, however. It looks both risky and expensive. The Adviceworx asset allocation view can be summarized as follows. We remain overweight global equities because of the greater opportunity set they offer and our long-term concerns over the structural vulnerability of the rand. We are gradually adding to our local equity allocation and remain neutral on global property. We still avoid local property because of the uncertainty over the long-term health of the sector and hold no global bonds unless specifically mandated to do so. We are also maintaining our tactical overweight position in local bonds. Thank you very much for your time and attention. We certainly live in interesting times, and I hope that this presentation will help you make sense of them. Should you have any questions or queries, please don't hesitate to contact me or your Adviceworx financial advisor. I hope you'll have a lovely day and a splendid weekend. Until next week, goodbye from me.